everyone, I'm Dr. Samuel Adebayo, and I am here to guide you on how to secure your financial future through smart investments. Today, we're delving into the world of investment diversification. Imagine a world where your financial success doesn't hinge on the performance of a single stock or bond. That's the power of diversification. It's the practice of spreading your investments around so that your exposure to any one type of asset is limited. This strategy can help to balance out the risks and rewards in your investment portfolio, ensuring that you're not putting all your eggs in one basket. It's a crucial component of long-term financial success. So, if you're ready to take the steps towards a more secure and prosperous financial future, you're in the right place. In the next few minutes, I'll be discussing the risks of having a non-diversified portfolio and the potential impact on your wealth. So, what happens when you put all your eggs in one basket? Let's explore. Imagine you're an apple farmer and you've got a single variety of apple trees. You've poured your heart and soul into nurturing these trees. They flourish and you're content. But one year, a new disease sweeps through the apple farming community and it targets your specific variety of apples. Your entire crop is wiped out. This, my friends, is a real-world example of the risks of non-diversification. Now, let's translate this scenario to the world of investments. Consider this. You've invested all your money in a single company's stock. Initially, the company does well and your wealth grows. But then, the company hits a rough patch and its stock plummets. Now your entire investment takes a nosedive. This, in essence, is what happens when you don't diversify your investment portfolio. Non-diversification is akin to betting everything on a single horse in a race. While you might strike it big if your horse wins, the risk of losing everything is also substantial. This is known as concentration risk. The risk associated with putting all your money in a single investment or a limited number of investments. Another risk of a non-diversified portfolio is market risk or systematic risk. This is the risk that affects all companies in the market, such as economic downturns or political instability. If your portfolio isn't diversified and one of these events occurs, all your investments could be negatively impacted. Think of the dot-com bubble of the late 90s or the housing market crash of 2008. Investors who had heavily invested in tech stocks during the dot-com bubble or in real estate prior to the housing crash bore the brunt of these market downturns. Then there's sequence of returns risk. This is the risk of receiving lower or negative returns early in a period when withdrawals are made from an individual's underlying investments. It's particularly relevant for individuals who are nearing retirement. If you're heavily invested in a single sector and that sector performs poorly just as you're about to retire, it could significantly impact your retirement income. And let's not forget liquidity risk. This is the risk that you may not be able to quickly sell your investment without incurring a loss. If you're invested in a single asset class and that asset class suddenly falls out of favor, you could find yourself unable to sell your investments without taking a hit. So, is it all doom and gloom if you don't diversify? Not necessarily. There can be upsides to a concentrated portfolio. For instance, if you've done your research and you're confident in your investment, concentrating your investments could lead to substantial gains, but it's a high-risk, high-reward strategy. And for most investors, the potential downsides of a non-diversified portfolio far outweigh the potential upsides. Clearly, not diversifying your investment portfolio can have dire consequences, but there are ways to avoid these risks. Diversification, spreading your investments across different asset classes, sectors, and geographical regions can help mitigate these risks. But that's a story for another scene. For now, let's just remember the old adage. Don't put all your eggs in one basket. It's as true for investing as it is for apple farming. Now, let's delve into various investment options available for diversification. We'll explore 4 main asset classes that can form the backbone of a diversified portfolio: stocks, bonds, real estate, and commodities. Each of these asset classes comes with its own set of benefits and risks, which we'll go over in detail. Firstly, we have stocks. Investing in stocks means buying shares of a company. When you own a stock, you own a piece of the company and stand to benefit from its success. Stocks can offer high returns, especially in the long term, which makes them a popular choice for many investors. However, they also come with a high level of risk. Stock prices can be volatile and can fluctuate based on a variety of factors, including the company's performance, economic conditions, and market sentiment. Thus, while stocks can be a great way to grow your wealth, it's important to balance your stock investments with other, less risky assets. Next, we have bonds. Bonds are essentially loans that investors make to entities like governments or corporations. When you buy a bond, you're lending your money to the issuer for a certain period in return for regular interest payments. Bonds are generally considered safer than stocks as they offer fixed returns. However, the returns are usually lower. Moreover, bonds can be affected by interest rate fluctuations. When interest rates rise, bond prices fall, and vice versa. Therefore, while bonds can provide a steady income stream and help reduce portfolio risk, they should be used in conjunction with other asset types for diversification. Third on our list is real estate. Investing in real estate involves buying properties for the purpose of generating income, either through rental income or capital appreciation. Real estate can offer a good hedge against inflation, as property values and rental income tend to increase over time. However, real estate investments require a significant initial investment and can be illiquid, meaning they can't be quickly converted to cash. Plus, property management can be time-consuming and costly. So, while real estate can be a valuable addition to your portfolio, it's important to consider these factors before diving in. Lastly, we have commodities. Commodities include physical assets like gold, silver, oil, and agricultural products. Commodities can act as a hedge against inflation and market volatility, as their prices often move independently of stocks and bonds. However, commodity prices can be extremely volatile, influenced by factors like supply and demand, geopolitical events, and weather conditions. Therefore, while commodities can add another layer of diversification, they should be approached with caution. As you can see, diversification involves spreading your investments across various asset classes. Each of these investment options, stocks, bonds, real estate, and commodities, offers unique benefits and risks. By understanding these, you can make informed decisions about where to allocate your money. Remember, the goal of diversification isn't necessarily to boost performance, it's to reduce risk. By spreading your investments across different types of assets, you can better weather the ups and downs of the market and set yourself up for long-term financial success. So, why go through all this trouble to diversify your investments? Well, imagine sitting in a boat with all your life savings in it. Now picture that boat with multiple holes in it. Doesn't sound like a great scenario, right? That's essentially what you're doing when you put all your investments in one basket. One wrong market wave and your financial boat could sink. But when you diversify your investments, you're essentially plugging those holes. making your financial boat more resilient and ready for any market storm. Now, let's delve into the benefits of diversifying your investments. The primary advantage, and perhaps the most known, is risk reduction. When you diversify your portfolio, you're spreading the risk across multiple investment types. So if one investment performs poorly, it's likely that others in your portfolio may perform better, offsetting the loss. This is the beauty of diversification. It's all about balance. It's the financial equivalent of not putting all your eggs in one basket. And while we're talking about risk, it's worth noting that diversification can also help manage volatility. Market volatility can send investors into a frenzy. But a diversified portfolio can weather these ups and downs with more stability. This is because different investments react differently to market conditions. So when one investment is down, another might be up, smoothing out the overall performance of your portfolio. But it's not just about risk. Diversification can also lead to potential increases in returns. Here's how. When you diversify, you're not just investing in different types of assets, but also in different sectors and geographical regions. This means you have the opportunity to tap into the growth potential of various markets. When one market is slow, another might be booming, providing you with a chance to reap the benefits. Now, this might sound counterintuitive, but diversification could also help you preserve your capital. You see, when you have a diversified portfolio, you're less likely to make rash decisions based on the performance of one single investment. You're more likely to take a step back, look at the bigger picture, and make informed decisions that protect your capital in the long run. Lastly, diversification gives you the flexibility to adapt your investment strategy as your financial goals and circumstances change. As you age, for instance, you might want to shift towards more conservative investments. A diversified portfolio allows you to make these adjustments without drastic changes. These benefits are not just conjecture, they're backed by an array of research and studies. For instance, a study by the University of Oxford found that diversified portfolios performed better than non-diversified ones over a 20-year period. Another research paper from the Journal of Finance showed that diversified portfolios had lower volatility and higher risk-adjusted returns compared to single asset portfolios. So, if you're looking to secure your financial future, diversification should be a key component of your investment strategy. It's like a safety net, shielding you from market uncertainties and providing you with opportunities for growth. Ultimately, diversifying your investments can lead to more consistent returns over time. It's a tried and tested strategy that has stood the test of time, and it's one that could help you navigate the world of investing with more confidence and peace of mind. Now that we've covered the what, why, and how of investment diversification, let's summarize what we've learned. We began by understanding the concept of investment diversification. We delved into why it's crucial for long-term financial success. Diversification isn't about putting all your eggs in one basket. It's about spreading your investments across different asset classes to balance risk and reward. In the world of investing, it's the equivalent of not betting everything on a single horse, but spreading your bets to increase your chances of winning. We then discussed the risks of having a non-diversified portfolio. We realized that putting all your resources into one investment is like walking on a tightrope without a safety net. It might work out fine, or it might not. But why would you want to take that risk when there are safer options available? A non-diversified portfolio exposes you to unnecessary risk and can have a devastating impact on your wealth. It's like building a house on sand. It might stand for a while, but it's likely to crumble when the storms come. Next, we explored the various investment options available for diversification. We understood that there's a whole world out there beyond stocks, bonds, real estate, commodities, and even cryptocurrencies provide opportunities for diversification. Each of these asset classes has its own set of risks and rewards, and by investing in a mix of them, you can balance out the risks while maximizing the potential for returns. We highlighted the benefits of diversifying investments. Reduced risk and increased potential for returns are the key advantages. Diversification helps to smooth out the bumps on the investment journey. It's like having a diversified diet. You don't just eat one type of food, but a mix of different foods to ensure you get all the nutrients you need. Similarly, a diversified investment portfolio ensures that your wealth grows steadily, even when some investments don't perform as expected. We emphasize the importance of taking action to diversify your investment portfolio. Knowledge without action is like a car without fuel. It won't get you anywhere. So it's not enough to know about diversification. You need to act on it. Start by reviewing your current investment portfolio. Look for areas where you are overly exposed and start diversifying. Seek professional advice if needed, but don't delay. Remember, the best time to start diversifying your investment portfolio was yesterday. The second best time is now. In conclusion, diversification is not just an investment strategy. It's a risk management tool. It's about ensuring that your wealth grows steadily over the long term without exposing you to unnecessary risk. It's about ensuring that you have a safety net in case some of your investments don't perform as expected. It's about securing your financial future. Remember, securing your financial future requires strategic planning and action. Diversification is a key part of that strategy. And with that, we come to the end of this tutorial. But remember, this is just the beginning of your diversification journey. So, go ahead, take action, and secure your financial future. Thanks for sticking with me to the end of this video. You've now unlocked the secret to securing your financial future through diversified investments. But remember, this is just the tip of the iceberg. There's so much more to learn, to explore, and to master. So, why not join me on this journey? Subscribe to this channel for more financial tips and investment strategies that will keep your portfolio robust and resilient. Don't forget to like this video and share it with your friends, family, and anyone who could benefit from this knowledge. And if you want to be the first to know when new content drops, do turn on your notification bell. We're in this together, paving the way to a more secure financial future. Remember, your financial future is in your hands. Start diversifying your investment portfolio today.